Do you really want to invest in the financial markets without knowing the basics? In this video, I will explain what inflation and deflation are and why interest rates are so important. What happens to your money when prices rise or fall? Let's discover together the connection between these phenomena and how they impact your life. Subscribe to the channel and turn on notifications to stay updated. What is inflation? A simple definition of inflation is the general increase in prices over time. So, if last year we spent $100 at the supermarket, this year, for the same purchases, we might spend $10 more. But what causes these price increases? Demand pull inflation. This happens when demand is higher than supply. Example, in a city, there are only a few houses for sale, but many people want to buy a house. Since construction companies can't build more homes quickly, the prices of existing houses will rise. Cost push inflation. Higher production costs and raw material prices lead to price increases. Example, if the price of oil rises, gasoline prices will inevitably go up as well. Expansionary monetary policy. When central banks inject too much liquidity into the system, the value of money decreases, leading to higher prices for goods and services. What is deflation? Deflation is a general decrease in prices. At first, it may seem like a good thing, but it's not. Let's understand why and look at its causes. Demand collapse and excess supply. Fewer people buy goods, increasing their availability, which drives prices down. Consumers, seeing prices drop, expect them to fall even further, delaying purchases and investments, which worsens the situation. Restrictive monetary policy. Central banks reduce liquidity, increasing the value of money, which lowers the prices of goods and services. Why do I decrease prices? As we have said, deflation leads to an increase in the value of money. This also leads to greater purchasing power. Example, if last year we could buy a loaf of bread with $1, this year with the same dollar we buy two. In practice, the price of bread has decreased per kilogram. This leads to less money circulating, causing lower consumption, fewer investments, and potentially stalling the economy. This is where the central banks come into play, such as the European Central Bank, the ECB, or the Central Bank Fed in the United States of America. These banks mainly use a tool to stabilize the economy and maintain sustainable growth. This tool is called interest rate. What are interest rates? Interest rates represent the percentage that a bank applies to a loan. Simple example. Imagine borrowing $1,000 with a 5% annual interest rate. After 1 year, you'll have to pay back $1,050, $1,000 plus $50 in interest. So how does the central bank use this instrument? During a strong economic recovery movement, we may see high inflation. As a result, banks will raise interest rates. This will lead businesses and citizens to apply for fewer loans. So less money to spend and markets slowing down. Conversely, during a period of strong economic downturn, we may see deflation. Central banks here will lower interest rates. Citizens and businesses will be more enticed to believe loans. Consequently, more money to spend and markets recover. Inflation and deflation are two sides of the same coin. Finding the right balance is a challenge of central banks. If you liked the video, please like it. See you in the next video to grow together. And most importantly, learn how to invest wisely.